December really jumped out. 3,706,000 ounces of gold were delivered and 64,730,000 ounces of silver. 64,730,000 ounces of silver were issued and stopped. That means delivered. And a mint box of Silver Eagles weighs 42 pounds. What does 65 million ounces weigh? And who's doing it? But this is every single month. I've been screaming this every single month since a year ago, November. That's the largest December influx in the history of the COMEX market, which goes back to 1974. And January, which is not a major scheduled delivery month, in just the first few days of the month, we've seen pretty damn well near 35 million ounces of silver delivered. 35 million in a non-delivery month within a week of trading. You add that to what we already saw delivered in December, and you're over 100 million ounces of silver that's been delivered in a little over, a month and 5 weeks.
December's precious metals activity stunned the COMEX market. According to widely discussed data highlighted by Andy Schectman, more than 64.7 million ounces of silver and 3.7 million ounces of gold were delivered in December alone, marking the largest December silver delivery since COMEX began in 1974. What's more alarming is January. Despite being a non-delivery month, nearly 35 million ounces of silver were delivered in just days. Combined, that's over 100 million ounces in roughly 6 weeks. Schectman emphasizes this is not a one-off event but a monthly pattern. The scale, consistency, and physical demand raise serious questions about who is taking delivery and what it signals for the future of silver prices. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
We have 3 million ounces of silver in our warehouse right here. I will sell 3 million on COMEX paper. So as one goes up, the other goes down. If I lose $10 an ounce on my 3 million ounces in physical in the warehouse, I make $3 million, or I make $10 an ounce on those 3 million ounces, $30 million on what I sold short on COMEX. Allows me to be market neutral at any given time, right? That's how the COMEX was designed, to hedge exposure and hedge risk. Okay, great. So there you got all these smaller and mid-sized coin companies who don't. I've been doing this for 36 years next month. I know all of the traders. I know all of the refiners. I know all of the major players, and I can very quickly move things around. If you're a small local dealer, you're a small company that really doesn't have the connections, you're working with one wholesaler or whatever it may be, when this stuff comes in, and for the last year or two, the demand by the public has been not so strong. Silver goes up to 50 and everyone starts selling this stuff, right? So the coin shops are filled with junk silver and no one's buying it. And so what do? They try and send it into the refiner to get it melted down. Now here's where it gets interesting. Remember what I said about hedging? So you're a refiner, and you're not a big one, or you are a big one. Let's say you're a big one. You have $50 million that you paid for in silver that you bought from the public. You bought candlesticks and flatware, you bought jewelry, you bought junk silver, you even bought doré. You got all this stuff that is in various stages of production. You have to melt it down into shot, which are like BBs, so you got to pull out the impurity and melt it down into little ball bearing size pieces of shot, and then from there you got to melt that down into your bars and your rounds, and the whole process in various stages can take weeks, right? Well, that $50 million in inventory, you have to hedge it, right? Or you've already paid the money, and what if the price collapses by $50 an ounce down to $30? You're out of business. You just lost, millions and millions and millions of dollars. You might as well shut down operations. So they hedge their inventory that they are working to sell. But because it takes several weeks, they're not selling it. They're not rotating their cash fast enough. So what's happened to their short position? As the price moves up by $6, bang, margin call. Bang, margin call, bang, margin call. And they're getting margin called to death. And so they're like, oh my God, if we don't put up this money, they're going to close us out. They're going to liquidate our positions. We're dead. We can't take any more business. We can't take any more business until we clean out this whole supply chain thing. We got stuff in works, yeah, but it's taking too long. And so what's happening is many of the refiners stopped taking new orders for the last several months, until they clean up their what they already have in production. And as a result, the big primary distributors or anyone making a market and the stuff was paying underspot for it. And I bought every single penny I could buy, literally, because I saw that very clearly. Now this will change, but it's really because the refiners are getting margin called with their exposure to big allotments of gold and silver that they are working on refining, not moving fast enough, and the margin calls, silver moving up so fast against their short position is creating a very, very big problem for them. That's why I was able to do it, and that's why the companies that bought a bunch figured it out. A little secret sauce of running a company for 36 years that you can see it, and that's just the way the market worked. I didn't set the price, but I took advantage of it, and I sold it to the public for $1 under spot. I didn't screw anybody, of course. I wanted to give that same value that we were able to get and pass it on. So that's why it happened, and it will, once this availability is gone industry-wide, premiums will go right back up. So I wouldn't sell it. I wouldn't unless I had to. I wouldn't reposition unless I had to because, by the time this fully flushes through, you'll see much, much higher premiums, if that makes sense.
This analysis explains how the COMEX hedging system is now stressing the physical silver market. Large dealers with relationships can hedge inventory by shorting paper contracts, remaining market neutral as prices move. Smaller refiners and coin companies cannot rotate inventory fast enough. They buy scrap silver from the public, then spend weeks melting, refining, and minting products. During that delay, they hedge by shorting futures. As silver prices surge, margin calls explode, forcing refiners to halt new buying and liquidate positions. This creates underspot pricing and falling premiums. Experienced firms capitalize while supply tightens. Once inventories clear and hedging pressure eases, premiums are expected to rise sharply across bullion markets. Let's get back to the interview.
The East is doing price discovery in the physical market, and the West is still doing it price discovery in the paper market. But this spread, which continues to widen both in lease rates, which were as high as 30 or 40%, you can lease metal for short periods of time to cover, whatever it is, to borrow it and sell it or sell short or to cover the need for it or whatever. You can do that. Those premiums are usually a fraction of 1%. They've been as high as 40%. They're about 8 or 9% right now. That's massively higher than what it normally is. And it disincentivizes leasing. Makes it really hard to cover a position when you got to pay 8, 9, 10, 30% to borrow the silver. But when this spread widens, when these two worlds stop agreeing, that's when the physical market begins to overrule the paper market. And that's when the dam breaks. And I would argue the move won't be polite. You're seeing some very, very interesting things happen with the banks. Now, I told you the Tom Luongo thesis, and I kind of expanded on it. And I believe that it could very well be true. And when you see the last CTFC bank participation report that just came out, it exposes what Tom's been talking about and what I've been talking about, adding to it this silver time bomb where non-U.S. banks are net short 206 million ounces or 33% of open interest. And these unrealized losses are biblical in scale, done again. And what the Financial Times article says and what the bank participation report largely corroborates is that U.S. banks are largely net long. And as their rivals are drowning in losses, then the U.S. banks are largely net long. They did the jiu-jitsu move and they flipped. Could be very interesting. I would say that all you need to see when you talk about what could be is the amount of deliveries. And they're not slowing down. The biggest December delivery in the history of the COMEX already this January, bringing in billions of dollars worth of gold and silver, and it's only 7 days in, but this has been every single month since last November, a year ago November. I think anyone who doesn't see this for what it is missing a very big picture. So even though we're at high points, so what? What is high when the metals have never been allowed to find price discovery? Why isn't people say that about the Dow Jones at 50,000? I started this industry, it was at 2,100 in 1990. So you tell me what is high when all of these other assets have been allowed to move higher in this inflationary world that we live in, making the people who hold assets wealthy. Why did they hold down gold and silver? And okay, they did. So now where does it go when it's no longer being held down? That's the big question. I would argue much higher with volatility, but much higher nonetheless, until we see a massive influx in gold and silver, additional supply. You haven't begun to see where this is going to go. And I was saying it to you back then that something is breaking in the system, that delivery is being prioritized over paper promises. And then we moved to, well, why are all the central banks repatriating their gold from the Bank of England and the New York Fed, which gave Western rule of law and access to the COMEX and the LBMA, right? Why are they doing this? So we've seen purchasing by the central banks. We've seen repatriation by the central banks. And let's take it one giant step further. Who the hell is doing it here in the United States? And when you talk to guys like David Jensen who tell you that the LBMA is
the global precious metals market is reaching a breaking point as physical price discovery in the East collides with paper-driven pricing in the West, a trend frequently highlighted by Andy Schectman. Lease rates once near zero have surged as high as 30–40%, signaling extreme physical tightness and discouraging short-term borrowing. At the same time, COMEX deliveries continue at historic levels, exposing a widening disconnect between futures contracts and real metal. Bank participation reports reveal non-U.S. banks massively short silver, while U.S. banks have flipped net long. Schectman argues this imbalance marks a systemic shift where physical demand will ultimately overpower paper suppression, driving significantly higher and volatile prices. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.